Hello everyone. The market continues to remain volatile due to tariff-related uncertainties, and the uncertainties remains the order of the day. Against this backdrop, the RBI not only cut the repo rate by 25 basis points to 6%, but also changed the policy stance to accommodative as we had anticipated. The MPC minutes indicate that the RBI is relatively more dovish than the market expectations. Key projections. Inflation. Inflation projection for FY26 have been lowered to 4% from 4.2. However, we believe it's likely to undershoot this target. A bumper Rabi crop harvest and an expected normal monsoon are likely to keep food prices soft. Additionally, the Brent prices are expected to remain subdued amid global uncertainties and slower growth. Growth. FY26 GDP growth has been revised down to 6.5%. Achieving this target will require continued monetary policy support. Liquidity. The RBI is actively injecting durable liquidity into the banking system. So far, it has conducted OMOs worth approximately 4 trillion rupees and FX swap totaling to about $25 billion. For May, the RBI has announced additional OMO bond purchases worth 1.25 trillion rupees. We also expect RBI to announce a dividend of about 2.5 trillion, which will further ease liquidity stress. The INR remained well supported, appreciating close to 85 mark, coinciding with decent recovery in equity markets in April. FIs have returned to equity markets, net positive back-to-back for the month of April to about $1 billion USD. Overall, the RBI is likely to maintain liquidity conditions such that overnight rates remain close to the SDF rates. Our outlook. Given the growth inflation dynamics and forward-looking projections, we expect at least 50 basis point further reduction in repo rate over next 6 months. The overall stance remains pro-growth and pro-market, with interest rates expected to stay soft. The 10-year bond is expected to trade in the range of 6.25 to 6.40 in the near term, however, shall move towards 6% as the additional rate cuts are delivered. With easing liquidity, corporate bond spreads are likely to contract across 1 to 7 year segment. Corporate bond spreads are currently in 60 to 70 basis point in 5-year segment and may drop to 40 to 50 basis point. SDL spreads may also witness some contraction in up to 5-year segment. Currently, they are trading at about 45 basis point, however, shall move towards 30 over a period of time. Key recommendations. We recommend actively managed duration funds or short-term funds for 12 to 18-month investment horizon. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.